Hi, everybody. It's Jessica Stone at Stansberry Research. I'm joined here by Mike DiBiase, who is the editor of Stansberry's Credit Opportunities, and we're here to talk about investing in corporate bonds. Now, of course, yields on your screen, if you're watching government bonds, they are sinking, but yields on corporate bonds are going up. Can you talk, Mike, about why that's happening right now and why corporate bonds do make sense to look at as an investment?
Yeah, thanks for having me, Jessica, first of all. A lot of people have never invested in corporate bonds before. They hear bonds and they think, this boring, low-yielding vehicle that only old people invest in, right? You get a couple of percent interest on bonds. And that's true of government bonds, things like U.S. Treasuries. But it's a very different story for corporate bonds. And corporate bonds are nothing more than loans that are made to corporations that investors can buy, just like a stock. And they usually have, you buy them for $1,000. That's considered the par value. And you get paid interest twice a year. And then at the maturity, you get paid your $1,000 back. That's the way they work. But what's different about corporate bonds is that they trade in the market just like a stock. So they could trade for less than 1,000 par value.
This is really about knowing the company that you're buying, right? Just like it would be in the stock market. And there are differences between investment grade and junk bonds. How do you describe the difference?
Right. So you can kind of divide the universe of corporate bonds up into investment grade and non-investment grade. And non-investment grade are sometimes referred to as junk bonds, right? And, the term junk sounds like something you don't want to be anywhere near. But actually, that's kind of what I specialize in analyzing in my newsletter, Stansberry's Credit Opportunities. A junk bond is a bond that's issued by a company with less than an investment grade rating. Every company gets credit gets rated by one of the major rating agencies like Standard & Poor's or Moody's or Fitch. As the company's business starts to deteriorate a little bit, or maybe their debt's gotten too big over time, they've made some big acquisitions and they can no longer handle the debt, it becomes riskier and their credit gets downgraded. And that's all it is when you say, investment grade versus non-investment grade. It's how much risk are you taking on, credit risk, that risk of that company defaulting.
Now, we're certainly hearing about the possibility of a lot of major corporations going out of business at a time like this. So there is, it seems, a higher risk of default in these bonds, would you say?
We've got businesses that are literally shutting their doors, for the next month, for a month or longer, right? So we've never seen that happen before. I mean, maybe, you could go back to wartime, right? World War II, where it happened last. So these are companies that are not earning revenue, right? And they still have expenses. They still have interest that they have to pay. They still have debt that, that's maturing that they're going to have to pay. So yeah, the risk of default is definitely heightened. And what we've seen in the corporate bond market is people are selling them. The prices of the bonds are going down and collapsing just like the stock market. So that's a very real default risk. Now, what we don't know yet, and certainly in more industries are affected than others, right? Industries like hospitality, travel, the airlines and cruises, restaurants, those are certainly more affected than other industries. So not every corporate bond is being sold off in equal increments, right? There are some that are still considered very safe today. The bond issued by a Costco or a Procter & Gamble would certainly be much safer than an airline bond from that perspective. But there's still a very big question mark about how much help they're going to get from the government, right? From governments around the world. They're injecting tremendous amounts of liquidity into the system, quantitative easing, lowering interest rates. There's even talk that, the U.S. may begin buying corporate bonds, directly buying corporate bonds, right? Helping out companies that need a lifeline that, can't pay their debt and they're going to get these loans, or maybe they might even guarantee the loans of companies as well to help banks and investors feel more comfortable, loaning those companies money to help them get through these difficult times.
That could increase the prices that they're selling for, though.
Yeah, that's right. That could help them. What we do in Credit Opportunities is try to recommend bonds whose prices have fallen, but who are still strong, fundamentally strong companies that can pay those bonds back over time on their own. So we're not relying on government intervention. But when I see corporate bond prices fall, I think, wow, I start to get excited. And because you can make a lot more money when you buy a bond cheap than when you can buy it expensive, right? The cheaper that you buy a bond, the higher your return is going to be, the bigger your capital gains are going to be. The key to all that, of course, is finding the bonds that aren't going to default, right? The ones where the baby's kind of been thrown out with the bathwater.
Mike, I think it's safe to say you love corporate bonds.
I do, Jessica. I live and breathe corporate bonds. I analyze, companies, thousands of companies. We do screenings every month, trying to find what we call the needle in the haystacks, right? Trying to find those bonds that have sold off that are super safe and investors can make big returns on. But now, in today's environment, what we're seeing is this is kind of the moment we've been waiting for. And I hate to say that because I know there's a lot of suffering in the world, health-wise and financial suffering. But investors need to know that even in times like this, there's opportunities to make big money and you can take advantage of these opportunities. But the average investor doesn't know about corporate bonds. They don't realize how much money you can make and how much safer it is than buying a stock if you know where to look.
All right. Well, I think that's a pretty good sales pitch for what you do and for your interest. And we'll sure, if people want more content, they can certainly go to stansberry.com or stay tuned and subscribe to this YouTube channel. You can also find us on Twitter and Facebook and Instagram. Thanks so much, Mike. We appreciate your time.
Thank you, Jessica. Thanks for having me.